Global equities have had an impressive year this year, more than most people had anticipated coming into this year, especially since there was concern over the economy. And when we look at asset allocation and we look at equities, first of all, we love equities for the long run. Equities, this is where you're going to get the most of your long-term return. But we want to add to equities and increase our equity exposure when we think that investors are being rewarded for all of the downside risks. And what we've seen this year has been good news, where we have started to see some of the equity returns broaden out from the large cap tech space into not only small caps, but also value. What we're seeing is, though, we're starting to get this feeling of some complacency in the market. When you look at this chart, this is just simply the S&P 500 price to earnings multiple. It's well above the historical average, and you have to go back to really the pandemics before you've seen elevated multiples like this. Now, we know the S&P 500 is not the entire stock market, and we still do favor value over growth because we think there's room for value to catch up to what we've seen in growth. And we think while they're elevated, their valuations are not as stretched as when you look in the large cap growth space. Now, from an economic perspective, we think these multiples are pricing in perfection. They're pricing in that perfect soft landing that everyone thinks the Fed can achieve. We think that just is a little bit too optimistic right now. We've outlined our concerns about the economic growth going forward. And even though we are consistently looking for opportunities to add to equities, we're going to look at when those opportunities, when the investors are being rewarded for those risks. And when you're looking at valuations, pricing in perfection, you're not being rewarded at this time. When you look at from an earnings perspective, the earnings expectation is that earnings will grow 15% next year. 15%. And when you look at this chart, the expectation for economic growth over the next year is just 1.8%. You have to go back to 2016 since we had 1.8% economic growth, and earnings were much lower than the 15% that's expected for 2025. So what does that mean? What should you do? How should you be invested? First of all, in the long run, we still want to find opportunities to add to global equities. We love the small and mid-cap space. Their valuations are more attractive, but they're also the most sensitive to interest rates because they carry the most floating rate and debt that's coming due in the next year or two. So we're concerned about the valuations we've seen here in the small and mid-cap space. We'll look for better opportunities. The developed international markets, they're not overwhelmingly more positive from an economic standpoint, but the one thing that they have for them that we like to look at is valuations are pricing in those downside risks. So if you look at the valuation, if you look at this chart, valuations in the international developed markets are historically cheap versus the US. This is when you want to add to these areas. This is something that we've looked at over the past couple months and have started to move some money into that. Now, the important thing with the earnings uncertainty, the inflation uncertainty, the economic growth uncertainty is still to have some dry powder. We understand that cash is not earning what it was 6 months ago. However, it still is earning an attractive return in comparison to these high elevated multiples that we're seeing in the equity market. So having some dry powder is still important over the next year. And that's something we'll continue to look at opportunities not only here in the U.S., not only in large cap, small cap, mid cap, but also we'll continue to look at both the developed internationals and the emerging markets when all of these areas are pricing in any of that downside risk.